Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm here with our host, Robb Fahrion. He's the CEO and founder of Flying V, our digital marketing partner. I am also here with Mark Rosano. He is the CEO of C6 Capital Holdings. Mark is an expert energy investor and a fantastic macro strategist, one of my favorite people to talk to about the markets. Mark, Robb, how are you guys doing today?
Doing great,
Uh,
Gary.
it's a pleasure. Thanks for having me.
All
Yeah,
right.
Mark, welcome to the show. Excited to have you on as well.
Well, thank you.
Gary, we've got the nice going Milton issue for this week. This week's five things. We're going to talk CPI, PPI. Of course, we're talking inflation, French elections, and goods prices and furniture, actually. So why don't we get right into it? Really excited to have both of you on the show together. I know you guys have chatted in the past, X spaces, different things like that. But yeah, my first time being with both of you on the same show. So I'm really excited. Let's start with thing number one, Gary, a dovish CPI print.
All right. So early in the week, we got the CPI, that stands for the Consumer Price Index. For people who don't follow this all the time, when people talk about inflation, they're typically referring to the CPI. Now, one of the things that we've said on the show constantly is that the CPI is inaccurate. Plenty of people call it the CP lie. It is absolute government propaganda. It is intended to understate actual inflation. Your personal inflation rate, the amount that your household expenses have gone up in the last year, are probably much higher than CPI. But when people talk about government data, this is the inflation index. It comes out every month. And I think it was Tuesday, Wednesday, something like that, we got the June number that showed a year-over-year increase of 3%. That was below last month's 3.3% and below the expected 3.1%. That was the lowest annual inflation rate in a year, although we had been there a year ago. This is a key thing. People like to look at the monthlies, and the June CPI was actually 0.1% below the May number. So we actually saw, for the first time in a very long time, a decrease in the official price level. Again, what's going on in your household may be very different. The key elements of the downward surprise, the more dovish print, meaning the CPI was lower than expected, was falling energy prices. Gasoline was down 3.8%. I know Mark has opinions on that. Looking forward to hearing that in 1 second. Chairman Jerome Powell, Federal Reserve Chairman Jerome Powell, was his usual cautious self, talking about being on the alert for potential inflation spikes and, particularly from energy price fluctuations. Mark, how big a deal was the decrease in energy prices, and can we expect that to continue? He said,
So,
knowing the answer in
so,
advance.
it's already actually gone back up. So on the gasoline side, we're actually already back above last year's numbers. The other thing that I always find funny is you forgot used cars. So used car prices were also, because obviously everybody buys cars on a daily basis. So therefore it's going to be, it has the weighting that it has. When you look at the things like to your point, and this is why we like to look at the specifics, because when you, and to your comment about how you feel at home, you're like, all right, well, that's not 3%. When I go to the store, when I pay my car insurance, when I pay my phone bill, all of these things look much higher. And it's because it is. If you look at those key pieces, I mean, you're closer to 7-8%. And then to your comment on keeping people in the dark, I mean, they've changed this calculation how many times over the last 40 years to make sure that people can't see what it actually is. So when you look at, like, made mention about gasoline, this is where we break it into flexible versus sticky, because flexible is something that can change readily. Like you fill up your tank 3 times a month, maybe 4 times a month. It's always going to be a different price. So it's going to flex. It's going to flex in different directions. Then you have things that are sticky, things that aren't going to change, that are going to be your rent, your cell phone bill, things that are more of a contractual basis where it's going to be the same month on month. Health insurance, another one. You've seen it actually didn't go down. It actually went up, which means that the flexible side was the one that moved the most, which is usually indicative of a pivot back higher, because everything's going to revert to the mean, as we've seen with gasoline, as you've seen with energy costs, as you've seen with food prices starting to pivot up, really making this inflation print more of a one-off and less of a change in direction in terms of disinflation, as they like to say.
Yeah, that everyone's so excited about disinflation, ignoring the fact that the price level for most people is way too high. I really like that you're mentioning food prices. That's been a long running theme here where we've talked about, the US Bureau of Labor Statistics is telling us that food prices are only up 1%. Again, I ask everyone in the audience, if your grocery bill is up only 1% this year, I would love to hear from you. That is not the number I'm hearing from anybody in my circles. That's not what I see when I go to the supermarket or certainly to a restaurant. Cutting to the end is, and by the way, Mark, you were completely right about used car prices. If we go back 2 years, something like 40 or 50% of the giant increase in the CPI that year came from higher car prices, used and new car prices. And so at this point, about 60% of that increase has been unwound, meaning used car prices are coming down. They're still high, they're still expensive, but the price levels are coming down. And so the fact that this item that had been responsible for a huge chunk of inflation in 2022 is now in steep decline, and we still have a positive CPI is remarkable. It's telling us there are a lot of other items that are not coming down and are still going up. The market, when the CPI was announced, and it's changed since then, took up the probability of a September rate cut from, I think, around 60% to in the 70 to 80% range. And so the market is expecting a rate cut in September. DKI has a different perspective. Our suggestion is that the Fed is likely to keep interest rates higher for longer. I came out with that view in writing ahead of the PPI, which we'll get to in just a minute. But basically, we're still, even at 3%, which I think is understated, we're still way above that 2% target, which is still 2% above what the target should be. And on top of all of that, I still think Chairman Powell doesn't love the optics of lowering rates just ahead of an election. I suspect that if he can wait, he will. The Fed wants to appear nonpartisan. I'm not saying the people in that building don't have their own political agenda, their own political views, but I think the appearance of neutrality is important to the Fed. I think they're going to do what they can to keep it. So, if the market's betting 80% for a rate cut in September, I'm taking the under on that. I think it's less likely. Mark, what do you think? Am I right? Do you disagree? What's your view on it?
Oh, I don't think we get a rate cut in 2024. I had that view at the end of last year. I doubled down or tripled down on that in January. And to your point, I think that it's more of an optics. People like to fight the 1970s comments, but when you look at what happened in the 1970s, i.e., 1978, they started to cut thinking that the trajectory was there. We're on the path, therefore we can start cutting. And what do we know? The path wasn't there. And I think later on in the show, we're going to talk about how that path changed, especially when you start looking at labor prices and what the small business is doing, because small business is 47% of the U.S. economy. And they're telling you, hey, prices are going back up, labor's going back up. So are you really going to cut in front of that? And one of the things I was looking for just now, because I had talked about it. So used cars and trucks was down 10.1% year on year.
The big number.
Motor vehicle insurance is up 19.5%. So what do you pay for on a monthly basis? How many cars and trucks are you buying? And how often are you paying your insurance? So when you look at just the bifurcation in terms of some of the goods versus services, the service side is continuing to go up. You're continuing to see that stickiness, and it's actually trending back up, which is one of the key leading indicators that we've talked about previously when you look at freight and as we look into PPI.
All right, Mark, I'm going to put you on the spot with a question. Then, Rob, we're going to turn it back over to you. Mark, we've got 6 more monthly numbers. Well, only 5 will be reported this year. So we're going to get 5 more monthly numbers for the rest of this year. Do you think the CPI, and I'm not talking about actual inflation, I'm talking about the CPI, trends down toward 2% over the next 5 months? Or do you think it reverses and goes back up? And just a reminder, that's where we were a year ago. A lot of people are saying, hey, the CPI is down to 3%. The Fed should ease up and start to reduce rates. But they forgot that a year ago, the CPI hit 3% and then bounced right back up. Andrew will put up that chart, but you'll see in the chart, we hit 3% a year ago and it went back up. What do you think? Do we have the current trend, or are we going to see a repeat of last year where it comes back up?
It's a repeat of last year. Typically July and August, you have an increase in inflation. So on a CPI basis, I think one of the things that we've been targeting is an increase in July and August, something flat from August into September, a little bit of a cooling into October, November, and then depending on how Christmas goes, you'll usually see another acceleration in December. So realistically, I think July and August is going to be very strong. September is going to show something a bit more aggressive than I think what people are hoping for, because that's when you get the culmination of back to school, what was happening there. And to your point, in terms of some of these pivots and what things look like, people like to talk about the year on year, but from your perspective, month on month matters more because you're seeing an increase versus last month, which was higher than the month before. So when you look at this is a compounding impact, which is why you made the comment about you want to talk to the person who's putting this together, because I do it as well. I want to know where they're shopping because I want to shop there as well. I want to know where they're getting their health insurance. I want to know where they're getting their car insurance because that's where I want to get my stuff as well, because I definitely don't see 3% in my daily life.
Right. Can we get Janet Yellen to go grocery shopping for us? How does this work?
I think we're all packed and ready to go wherever that may be. And Gary and I have been asking that question. I think Mark's going to come along with us too.
Yes.
But gentlemen, good discussion there. And like everybody that listens to the show, say it together: higher for longer, coming from DKI, and looks like Mark's on board with that too. Thing number 2, we're moving on to PPI. Gary, the PPI comes in hot. Thing number 2 on this week's version.
All right. The PPI stands for Producer Price Index. It is different from the CPI. It's similar, but it measures price changes experienced by manufacturers and suppliers of goods and services. So a way to think about this is the PPI is the precursor to the CPI. If your manufacturers start to see price increases for the raw materials they use or for the components they use, you're going to see higher prices a couple of months down the road. If their prices come down, if the PPI prices come down, the producer prices come down, then we'll see a lower CPI. So the PPI is a good way to predict the CPI down the road, through the sales cycle, a couple of months down the road. This, unlike the CPI, which came in below expectations, came in really hot. The annual PPI last month was up 2.6%. That was well above the expected 2.3%. For people who don't follow this all the time, usually when the predictors, when the economists are wrong, they're off by maybe 0.1%. Given the complexity of these issues, that's actually not bad, right? Like if you can predict these things to within 0.1%, as an economist, you're doing a pretty good job. This was a situation where the miss in this case was 0.3. That's about triple a normal miss. That's a big number. The core PPI was even a bigger change. So the core excludes food and energy. That was up 3%. That was way above expectations of 2.5% and above last month's 2.3%. These are huge, huge misses by the analyst community. This is an indicator that what Mark was saying just a few minutes ago is likely to be right. When you see the PPI rising this much in this short a time, it would not be a surprise for Mark to be right and for the CPI to rise. Mark, the question I want to ask you, I would love for you to give the explanation that we talked about before on the monthly numbers, because it looked, when you looked at the core number, people were expecting a monthly core increase of 0%. And the reported number was just a little bit above that. And your point is not even close. You got this with a huge increase. I would love for you to explain to people how you're coming to your numbers, because I agree with your analysis, but I don't think a lot of people are focused on it.
So one of the big things that happens when the data comes out, because a lot of these are surveys, so you're usually not sure, you're trying to estimate, you're trying to use statistics to close the gap. But because the surveys are getting less and less consistent, you're seeing a lot of revisions. And one of the biggest things that we saw is a huge revision up. So when you look at core PPI, for an example, last month was revised from 0% to 0.3%. So when you have that 0.4 that happened this past month, you're actually increasing off the revised number. So you're seeing this big pivot up and this big revision, which typically PPI is about, let's call it anywhere from 4 to 8 weeks in advance of what you're going to see coming down the pipe. And that's where, when you see a lot of the differentiating problems, especially when you look at core, and then you look down into the different transportation services and the other underlying components that are showing that things are starting to accelerate once again. One of the other key components that we look at is final demand. And PPI final demand is, what is the final product? Like as Gary was talking about, there's different pieces, there's freight, there's all these different components. But when you look at what is the cost of that final product, and you actually had a really big acceleration, which is showing that that's going to show up at the consumer level, because that's what I'm buying. You're seeing that get passed through as much as possible. And these are those increases where not only is the revisions going up, so the increase was much bigger than initially expected, but also that final demand is showing that it's really going to show up very quickly, which is why we do think it's going to be that increase next month.
So the increase that you had calculated, once you include, this is on the core number, the adjustment for the prior month, it really looks like the increase for this month, including the prior month revision, was 0.7% above expectations. Now, for people who think, okay, wait, is that a big deal? If I'm paying $100 for something, is paying, $100.70, is that a big deal? And yes, and here's why, because it's in 1 month. If you annualize that, you come to a number just under 9%. And so, listen, does the PPI up that much in 1 month mean we're going to have 9% inflation again next month? No, absolutely not. But it is not a good sign. And, again, after the CPI came out, the market thought the probability of a September rate cut was about 80%. Powell looks at this. I think when he saw that, he had to think, yeah, we're going to have to hold off. This really, that puts a hammer in the higher for longer thesis that we've had forever. And, I know we keep coming back to it, but this is now over 2 years that all of these market observers and market participants have been saying the Fed's going to pivot, the Fed's going to pivot. 2 years later, they've been wrong. The bond market, supposedly the smart money, they've been wrong for 2 years. We've been sitting here saying higher for longer for 2 years. And this is where we are. And I think that's going to continue for a while.
Yeah, and I think the biggest point as well, because to your comment about, well, where's it going to show up? As a business owner, you're like, okay, well, can I pass it down, or do I have to eat some of my margin? Because you're looking at that pricing, you're like, all right, well, let me take and feel out what is happening at the consumer level. Where's savings? Where's excess savings? Where's credit card debt? And if you go down that list, you're like, ooh, consumer savings is pretty much gone. You have credit card interest rates on average at 24%, at the maximum 28%, a compounding pressure point, and you have credit card debt at record highs. So it's like, okay, well, how much of that can I push down? And so far, they continue to see the ability to pass some of that through. But when you see that stop, that's when you start to get those big earnings revisions. That's when you start to see that show up in the corporate data, and you're starting to see some people waffling on what that second half is going to look like, because it's going to be a matter of how much longer can the consumer eat the pain.
For all of you out there, say it with us again. Higher for longer here at Deep Knowledge Investing. Gary's taking the under on the 80% as well, so mark that one down. Thing number 3, moving forward, talking all of our best friend, Jerome Powell. Jerome Powell testifies on Capitol Hill, Gary.
Yeah, Rob, I don't know what's going on here. I've been so critical of the Federal Reserve for years. I've been critical of Chairman Powell. And here we are. This is like the 3rd or 4th week in a row that I've defended him.
Yeah, we are. I think he maybe he's got your ear, and I don't know. I think you guys may be talking behind the scenes. You guys seem to be quite aligned.
I don't know. All I can say is he hasn't paid. He's not even a Deep Knowledge Investing subscriber, but he should.
Yeah,
be.
That's true. I can confirm that.
I know, this is terrible. Anyway, Chairman Powell went to present before Congress and the Senate, as he does a couple of times a year. And he presented the Fed's semi-annual monetary policy report. It's usually a chance for the chairman to present his view on what's going on, and then for lots of Congress people and senators to grandstand and, scream about their own political priorities. It's generally not so conducive to good discussion. That said, one of the things we've talked about a lot here at Deep Knowledge Investing is the quiet war between the Federal Reserve on one hand, which is trying to reduce inflation and cool the economy by raising interest rates, and Congress and the White House and the Treasury on the other hand, who are spraying enormous amounts of overspending and stimulus into the economy, basically undoing everything that Powell's trying to do. And Powell's in a really delicate situation. And the reason for that is because all he has control over is the Fed funds rate. He doesn't have control over congressional spending. And again, he wants the appearance of being nonpartisan, being non-political. Now, in this case, as we've said many times, governmental overspending is a bipartisan problem. Both parties spend way too much. We're not taking a, red versus blue side on that. But I thought Powell handled himself really well. And when he was in front of Congress, he put the blame where it belonged. He talked about that the path that we're on in terms of spending being unsustainable. He's right about that. There is no way to get inflation under control when Congress is stimulating the economy, especially in relative peacetime, by trillions of dollars a year. And he gave a warning to all the people who were basically saying, hey, we should get rate cuts in July, and if not July, September. He said, look, we have a strong labor market. We have a strong overall economy. And he just flat out said, this gives us time to think and act in a considered, slow, measured way. We don't have to do emergency rate cuts here. And so, what I've said all along is that, eventually the Fed will cut, but it's not going to come anytime soon. The thing that would make me wrong is if the economy really does fall off a cliff in the next 6 weeks or so, then we'd see a September rate cut. Anything with the labor market the way it is now, the economy, the official numbers, not the real economy, the official numbers, the way they are now, and Congress spending like this, I think he holds firm. And I think he gave Congress a warning, which, Elizabeth Warren didn't like. And, watching the two of them go at it was both horrifying and funny. Mark, I know you saw that clip.
Yeah. Oh, I did. So when you put it into perspective on the deficit, Biden 21 till now is at 7.5, minus 7.5%. So when you think about it, World War II was 12.2, World War I is 4.8. So we've been at a deficit spending aggressively. And one of the things that I think people don't appreciate, and again, not that you're going to, because this is something where you have to get into the weeds, is there's still a supply demand number. And when you have Yellen saying that we're going to print money blindly because we're just going to issue debt, he's looking at this and saying, okay, well, who's the buyer? Like, who's the buyer of last resort? So sure, you're going to issue, let's just say, $1 billion of 30-year note paper. So you're going to do $1 billion of that, but then that's just because you're rolling what just expired. So what expired was $1 billion. So you have to put $1 billion back out there. But then there's the interest on that you have to include to it. Oh, and by the way, we're still spending more, extra money. So you have to put more money on top of it. So $1 billion is maturing and you're issuing 1.5. So you're continuously increasing the amount of paper. So when you look at the world at large, we're clear over now 300 trillion in what's out there and growing. So who is the buyer? So then it comes down to the indirect buyer. The indirect buyer is just, for layman's terms, it's just the foreign buyer of U.S. paper. When you look at that number, it keeps going down because, well, at what point is there the clearing price? And the clearing price is always going to be so important because the government's going to want a low interest rate. But where are you going to take the risk? So that's when you start to see that movement higher. The 30-year that just came out, the 30-year auction was a very weak auction, which means that the interest rate was much higher than what was expected because people are demanding higher risk premium, and that continues to move. So Powell is looking to say, guys, you want me to cut rates? I'm going to lose control of yield. And that's what you saw happen in the late 70s, which Volcker had to get in front of to get control of rates Once you start entering that spiral, you then spiral out of control, and you need a massive, earth moving type, mountain moving type situation to cool things off. And that's what he's trying to avoid. So how do you do that? Higher for longer. I'm going to stay here until you become a better actor or a better manager of your finances.
Yeah, I think it's fascinating that Congress keeps screaming for Powell to lower rates. And he's basically telling them these treasury auctions are not going well. You guys need to cut spending. And their view is no, just lower rates. And the reason for that is because the vast majority of Congress is economically and financially illiterate. And the other part of it is they don't care. They want to finance our debt using inflation instead of through taxes and a real discussion about the proper rate of spending, the proper levels of spending, because they can blame inflation on everybody else. And then, they can blame inflation on corporate greed, Vladimir Putin, the boogeyman, everybody but themselves, right? And so, I think the point that you're making on Treasury Secretary Yellen is a great one. It's one we've talked about here as well. So for people who are, coming in a little bit late, what Treasury Secretary Janet Yellen is doing is she's shortening the duration of our bond portfolio. And that's just a fancy way of saying, maybe we have 10-year debt that matures and needs to be refinanced. And instead of refinancing that with 10-year debt, maybe she's refinancing that with 1-year debt. Or maybe we have 2-year debt that's maturing and she's refinancing that with 6-month debt. And that's fine. But the problem with it is it means that you have to refinance that debt more often, and it increases the size of the treasury auctions. And so, as Mark pointed out, it's a supply and demand issue. What Yellen is doing is vastly increasing the supply in each one of these auctions. And we've seen very, very large tails on these auctions. That's just a finance way of saying exactly what Mark said, which is less demand than hoped for, meaning a higher yield. So the prices come down and it's costing the government more to fund itself. And one of the places I got into a mini discussion, not a bad debate, but a little bit of a discussion on Twitter or X over the weekend, where somebody was tweeting at me or posting at me saying, Powell should lower rates. If he does, it will save the government money on interest expense. And look, I understand why this person thinks that. But I think what they don't get is Powell doesn't have control over the entire yield curve. He sets the Fed funds rate. That is the overnight lending rate. That's just the overnight rate. The 6-month, the 1-year, the 2-year, the 10-year, the 30-year treasury bonds, those are set by the market. They don't have to follow, the reference rate by the Federal Reserve. And in fact, frequently they don't. If any of you have heard talk in the last year about an inverted yield curve, what that means is that it's a simple way of saying that bond prices are not as we would expect them to be. So, the bond market doesn't always agree that they want to get in line with what the Fed is doing. Powell doesn't have control over all of that. But what Yellen is doing is actively making it more expensive for the U.S. to borrow.
Yeah,
Mark, anything else to add there?
Yeah, I absolutely. So when you look at what's happening, there is this that supply demand. Like when you're looking at, not only is it an issue of the supply demand, that the new supply we're coming out, but also to Gary's point, people also have to adjust what their portfolios look like. So when you look at Japan, when you look at those foreign buyers, they may start being net sellers. Now, all of a sudden, they need to pull dollars forward, and they're now increasing the supply even further. So you have this shift in terms of not only new supply, but also old supply that can come back to market as people are trying to manage, to Gary's point, that duration risk, because they want to make sure that they're balanced. We've seen what happens with small banks and medium-sized banks. And I think that's that risk that continues to permeate throughout the U.S. economy is, how safe are banks? How safe is their duration risk? What does their hedging look like? Because you're continuing to see asset prices come down. And as those asset prices come down, all of a sudden that bond portfolio is very risky. And how do you do that? Well, you have to liquidate. If you liquidate, what's more right now, still more liquid than anything else, your treasuries. So all of a sudden you see these big flexes back and forth, and the Fed is sitting here saying, guys, like, we need to rein this in. Like, we need to slow this down. We're not, I mean, he's not sitting there calling for austerity, but which we more, I think most people would agree we need at this point. But at how do we slow the tide to try to adjust this to make sure that we can get our feet underneath us prior to a much bigger issue that that could come?
Maybe we can all say it together: higher for longer at DKI and ongoing. Thing number 4, hopefully I won't say that for the rest of the show, but no guarantees. Thing number 4, Gary, we're moving to France. French elections follow the UK model.
So this has been a fantastic benefit. New DKI intern Alex comes to us from the University of Exeter. He's doing a phenomenal job really early on. But because we have him here, we're getting all kinds of fascinating European political analysis, which I think is terrific. Last week, we talked about the UK election, where the Tories, the Conservative Party, were voted out of power for the first time in 14 years. Now, in fairness, the voters were fed up with Tory mismanagement and a general inability to get anything done, including the things they did have control over. They were fairly inept in the way they conducted themselves. But a big part of the story and a big part of Alex's analysis is that the Tories didn't really lose as much as you would think they did. What happened was Nigel Farage's party ended up splitting the vote. And so they didn't get the Labour Party in Great Britain won an enormous number of seats and the right to select the new prime minister. But they didn't win a much larger share of the vote. It's just the parties on the right split that vote. We saw the same kind of thing happen in France. It was a similar situation. Macron's government was in trouble, not in a good place, and was being challenged by Marie Le Pen's party, which was looked like they were going to win a ton of seats coming from the right. And France has a number of left-wing parties, and what they did was extremely strategic. They basically banded together and pulled all of their candidates except one in each one of the runoff elections. So they basically had a first round of elections, as they do in France, where Le Pen's right-wing party did extremely well. And then in all the runoff elections, there may have been 3 or 4 left-wing parties, and they just looked and said who performed the best. And, so they had, 1, 2, 3, 4. And the parties behind the second, third, and fourth best performing candidates, they pulled their candidates and said, you know what, we don't need to win. Our side needs to win. And they were able basically to rig a landslide. And I don't mean rig in a dishonest way. I mean, what they did was extremely strategic, where parties were pulling their own relatively successful candidates to make sure that Le Pen's party was not successful overall. They managed to do it, and the right-wing party underperformed expectations and left Macron still in power. And with the left in charge in France, expect higher taxes, higher spending there, and probably some of their citizens departing for other places, either in the EU or maybe better tax havens. Mark, what do you think? Have you been following French politics?
I have, unfortunately, because who loves politics more than me when it comes to just following the U.S. politics. But when you look abroad, it's funny because even Macron is sitting there and based on the policies that have been put out there, even he's saying, is like, hey guys, this doesn't work. This is going to breach EU protocols. When you look at some of the levels that you're talking about spending, there's still this renewed push in terms of the environmental side. When you look at this additional spending into green, and you have to turn around and say, you have the greenest, most prolific nuclear system in the world. Why are you not going to optimize that? Why are you continuing to throw money after things that we know work, but with significant limitations, especially when you look at the intermittency of it? So when you look at their plan, it's going to fall flat. It's going to just make the situation worse. And it's funny, to your point on the bond market earlier being the smart money, when Le Pen was leading, the bond market all of a sudden said, this isn't good. And they were like, all right, well, so you want Macron's side, but yet they spend frivolously as they continue to. But that means that they're going to be in a worse situation and actually fall out of the protocols that have been set up from the EU. The last point is always going to be what is happening on the immigration side. You know, you're continuing to see these horrific things coming out in terms of these different stabbing attacks, these different increase in criminal activity, and there are areas that are now quote unquote no-go areas when they're only continuing to go, where essentially the cops are saying, look, we only have so many resources. We need to focus on what we control, and some of these are out of our control. That only carries for so long until people get disgusted and start to take, things into their own hands, and that creates less control, more anxiety. And I think that that's only going to continue to show up in the economy, which is then going to require more subsidies, more stimulus, and you continue to see this spiral to the downside.
Yeah, there years ago, there were stories about some of the fire departments in Paris. Even if a building was on fire, they would not enter certain neighborhoods unless they had a police escort. And that's a situation where, if for anyone who's been to Paris before, there are no spaces between the buildings, right? It's like New York, where you have entire blocks of buildings that are connected. And so if one building on that block catches fire, the entire block is at risk of going up in flames. It's a lot of people there. And those buildings tend to be like 5- and 6-floor walk-ups, I believe. So, evacuating an entire block is not easy. That's the kind of situation where a delay is significant. And if the fire department doesn't feel like they can get there safely, that creates a huge problem.
Yeah. Sorry, go ahead.
Go ahead, Mark. Go ahead, Mark.
No, I was just going to say, I think the biggest thing is going to come down to the spending, because that is going to be front and a lot of those political things on the streets. That's something that is a slower burn and then starts to really pick up. But when you look at the spending, I think that's when you're going to start to see some real panic, and I think the bond market is starting to sniff that out. And when you look at just where that direction, I think that is going to be one of the biggest issues, because everyone likes to point to Germany. Obviously, France is the second largest economy in the EU. And if they start to go down that route, it's only going to be a slippery slope, because everyone's going to say, well, if they can do it, I can do it. And we saw what happened in 2011. We saw what happened with the European financial crisis. And let's be fair, they've never really recovered when you look at consumer spending, when you look at investment. And then the last piece is, what is your energy security? If I am a heavy consumer, whether it's an industrial, whether it's a chemical, whether it's fertilizer, I'm going to consume a lot of power. Now, what is my power price going to be? What is my natural gas price going to be? If I don't have a semblance of an idea of what that's going to look like over the next decade, I'm not investing there. I'm going to invest in Texas. I'm going to go somewhere else that's going to have a much, not even a better return, just a more stable organization where I can say, okay, I know I can get my natural gas here. I know I can get my electricity here. These are the wholesale rates. Let's invest here instead of building something new in France and Germany, where those unknowns are only going to increase based on how this election played out.
And by the way, you're right. France gets about 75% of their energy from nuclear power, which is the most stable, inexpensive, long-lasting way that you could possibly set up a grid. But, so that should make France a great destination for industry and businesses. But now the new parties that have won are talking about tax rates of 90%. And how do you do that? Who is that owns a business that cares about power prices or infrastructure, says, yeah, I'm going to move there. I'm going to put my business there and get taxed 90%. They're killing their own growth.
Anything else, Mark, that you would add to that before we move on to point 5?
I think it's a great point, and it's something that has to be talked about, because everyone thinks like, oh, I'm going to tax the rich. It's like, well, if they're already rich, then that money is elsewhere. Like when you're doing a tax rate like that, you're taxing people that are trying to get to that level, that want to work, that want to go out and earn that. and you're taxing away their ability to do it. So to Gary's point, it's like, well, why am I going to stay here? I want opportunity. I want the ability to move up this socioeconomic ladder, and you're going to slap me down if I start to be successful. It's like, so you're talking about renewables and moving away from nuke. Now you're also going to come directly after me with that is trying to move my family along, move my company along. Nope, I'm going elsewhere. And that's how you see that brain drain. That's how you see the industrial base moving. And that's when you start to see those jobs running elsewhere.
Interesting stuff coming out of France. Alex, if you're listening as well, thanks for that insight. And we'll be sure to stay on top of developments there. Final thing for this week's 5 things. This is a fun one, actually, Gary. Well, not that fun, but fun just based on the nature of the story. Thing number 5, local business insights on inflation.
All right. So this comes from our other DKI intern, Andrew Brown from the University of Tennessee. Andrew also is doing a fantastic job. Andrew's parents own a furniture store. And, we've been talking a lot about disinflation versus deflation versus price levels. So let's just take a quick moment to define all this, right? Inflation means increasing prices. Disinflation means prices are going up, but at a slower rate. Maybe your inflation rate goes from 10% to 5%. Prices are still up, but it's disinflation. They're going up at a slower rate. Stable prices means your prices are basically flat from where you were a year ago or a month ago. And deflation means lower prices. So one of the big problems we've had is economists here in the US are saying this is fantastic. We have disinflation. Our CPI came down from about 9% to 3%. That's 6% disinflation. That's terrific. The problem is that prices in many cases went up so far and by so much that they reached these price plateaus that are unsustainable for people. And so what Andrew did was he went back through his family's business, their records on sofa sales, which I got to tell you, I thought it was a really clever way to present the problem. It was really creative by Andrew to come up with this. And here's what they had. The average price of a sofa in 2020 in his family store was about, I'm looking at a bar chart here, about $2,200, something like that, which, seems like what you would expect. In 2021, the average sofa price rose by 34%, 34% to right around $3,000. Over the next 2 years, the average increase in prices went up 1.6% and 0.75%. So you have all these economists saying, hey, this is phenomenal. Your sofa inflation is only 1.6%. Your sofa inflation is only 0.75%. Look, things aren't getting more expensive. Okay, well, technically true, but like Mark was talking about buying a car, people don't buy sofas every month. You buy them periodically. And if you move and you need to buy new furniture, or you have a problem with yours, or it's just time to replace it, all of a sudden your price level went from about $2,200 to about $3,000. This is what we talk about. This is what we mean when we talk about price levels, right? So what Andrew's saying is we haven't had a lot of price inflation in the last 2 years, but the price levels are such that it's unattainable for a lot of people. And I thought it was a great way to demonstrate with a practical example of something that everybody has bought at some point in their life, or almost everybody, to show the difference between inflation, which can come down, but high price levels where things are still unaffordable for people. Mark, I know you've done a ton of work in the small business space. What are your views on this? Is Andrew looking at this the right way?
Absolutely. And it's funny because when you look at the ability to raise that, because you might be saying it's like, well, if Raymore and Flanagan is charging $2,700 for a couch, I'm going somewhere else. And then you go somewhere else and it's like, oh, they're $2,900. And then you look somewhere else and you're like, oh, well, they're $3,100. You're like, oh my God, the market's reset. And that's when you start looking at the NFIB, or looks at small businesses on a broad scale. And one of the interesting things, to your point before about looking at small businesses, things happened in uniform. So when you look at post-COVID, you had 75% of small businesses raising prices. So, but then obviously post-COVID, things start to normalize. That starts to come back down. We hit a low in the end of 2023 where only 20% of small businesses say they were increasing prices. So in your head, you're like, this is great. Things are getting better. But now it's 27% are saying that they're increasing prices. So when you start looking at this, all of a sudden we've hit that floor and things are starting to bounce back up. And there's a lot of reasons why. Freight prices. When you look at freight cost, what does it cost me to go from point A to point B? And if you go back since 2010, this is the largest price, taking away the COVID spike. I know COVID happened. The COVID spike, this is the most expensive it has been to move freight in the last 20 years. Then you look at compensation plans, back to your point on labor. When you look at labor, this is the compensation, the plan compensation in June was the largest increase since last November. So now you have a situation where small businesses still need to increase compensation. So they're going to increase that and they're going to try to push through that price as much as possible, which is why when, pulling everything together, you look at PPI, final demand, that final product is going to be more expensive. It's until the consumer says, I refuse to pay that you start to see that flatlining and that decline. Because if all of a sudden couches are amassing in inventory, they're going to have to look at that and say, okay, well, I can't charge $3,000. What if I charge $2,700? But that inventory costs something. So who's going to lose that margin? And then it's going to be the furniture company. And that furniture company is going to push back to the supplier and say, hey, I paid X. I now have to pay Y because I'm getting hit at the front end. That's when you start to see a meaningful hit. We just haven't seen it yet. So when everyone keeps saying, oh, cut rates, it's like, guys, where do you see the reason to cut rates? There's liquidity, pockets of liquidity everywhere. And now you're seeing these compensation plans. You're starting to see these prices going up. It has to really have a meaningful slowdown before you can see those rate cuts.
Gary, one thing that Andrew pointed out too, and Mark, those are all great points that you just brought up there, was also the disparity between, I think what they talked about, like high price sofas, right, versus their discount outlet, let's call it sofas, and the numbers there just in terms of, I think it was overall sales in those two segments.
Yeah, they have a high end version and a low end version. So basically, it's interesting. We've been talking for months here about a bifurcated economy, and I've been having, polite, respectful disagreements with economists and market strategists who are saying, no, the economy's in great shape. The aggregate numbers are fine. And, I've been saying the aggregate numbers are fine, but you have government spending pushing out the private market, and a lot of people are really not doing well. And so, what Andrew's parents have done, which I think is really smart, is they've got multiple lines, and they have a high-end line for people who are doing well, and they do have a discount line where those sales are down 16% year to date. The higher price section has seen an 11% increase year to date. And so, that's basically what this one furniture store is telling you, is the same thing we've been saying for months. You have a limited number of people who are doing really well and a large number of people who are struggling.
And
Mark, anything else to close us out? Go ahead, Mark.
Sure. So then that's the another key thing when you look at CPI, it's replacements. At what point can you no longer replace? So one of the things that we always look at is, especially when you look at Target, when you look at some of these pieces. So obviously at the top, you have your Nordstroms, you have your Lord and Taylor. Then at the next level, you have your Macy's. Then at the level below that, you have Target. Then below that, you have, let's call it Walmart. Where do you go below there? Like, at what point do you see? So when all of these prices are going up, it's because everything's going up. Even the discounted ones are going higher. But once you get to a point, then everyone starts getting pickier. They're like, okay, well, I'm going to come down in brand. I'm going to come down in quality. I'm going to come down, or I'm going to offset with maybe buying, more, going to the Costco's and Sam's Club of the world. So when you look at these pivots at some point, there's no replacement. So now you're either not buying a 3-person couch, or you're buying instead of buying a sectional, it's only a 3-person. Then it's a love seat. Then it's a lounge. And you see this consolidation, and that's how the buying the buying apparatuses have changed. So when you start looking at, looking at different investments, when you look at multiplier effects and rates, people have the wrong hurdle rate. So if I'm a small business, if I am a business that is looking at this saying, hey, there's an opportunity here, I'm going to go borrow money, I'm going to go invest, and I'm going to hire people. Well, as inventory builds up, and if all of a sudden the market starts to change, you're like, well, I'm not going to build something at the higher end, I'm going to build something at the lower end. And then as the lower end starts to build up inventories, well, then those investment plans are going to change, because I'm not going to get my yield. I'm not going to make the money that I expect, because those inventories. So not only are changes happening in terms of where money is going now, but it's also, where's my investment money going to go? Where's my expansion going to go? And that's where you start to see those things catch up. But as we've been seeing, as we've said before, it takes time to see people rationalize their spending and slow down some of their CapEx plans, slow down some of that expansion. And that's where we continue to see some of these different hits and some of these different pockets really start to show some of those cracks that have not really hit the economy in the bigger numbers, but in the small business in these other areas. And those are things that are going to essentially accumulate over time, which is what we see really starting to hit more Q1 of next year.
Hey, Rob, we should call this segment Mark Rosano's story of how he got an ottoman.
Yeah, from sectional to 3-seater
Yeah.
to ottoman.
Right.
Exactly.
He's got a stool.
Yeah.
Yeah.
And let's be fair, I found it. It was during the garbage day, and I saw it across the street. I said, "Hey, I think I could reupholster that."
Yeah, not bad idea. I saw one on the street the other day too. And then actually the guys right next door are called the Leather Doctors. So hey, if you need it, ship it my way, we'll get it done and ship it back. That'll probably cost you just as much too. But I didn't think you guys were gonna make me say it, but thing number 5 make me say higher for longer once again. So that's the wrap on this week's version of the 5 things, the nice going Milton issue. Mark, pleasure to have you on. Be sure to check out Mark and his social media. We'll be sure to include links to his website, social media accounts, etc. And as always, thank you so much for watching and listening. Please head to deepknowledgeinvesting.com. Check out all of our great content there. You can sign up for a free subscription to be notified about new postings, as well as the option for a premium subscription to get access to all material, Gary's current recommendations, as well as all of these insights prior to anyone else. Gary, Mark, leave the floor to you guys for some closing thoughts.
Yeah, just a couple of thank yous on my end. First of all, great job by interns Alex and Andrew. Those guys did the heavy lifting for the 5 things this week. I thought they did excellent analysis, picked great topics, really solid work by a couple of young men. It was great to see. Also, shout out to the guys at Contrarian Investor Media. They were very helpful in answering some questions I had about the PPI and providing their analysis. I thought they were concise and smart. Great job. Check them out. They're on Substack at Contrarian Investor Media. As always, Mark, it is so much fun doing these things with you. I always love our conversations. When Mark and I get on, it's basically just like the two of us. We have regular phone calls and it just goes on and on. Rob, always a pleasure doing this with you. I really appreciate the fact that you make time every Monday to host the 5 things. And for everybody watching this, thank you. We know your time is valuable. We really appreciate it. We appreciate you spending it with us. Thanks.
And we're already at the top of the hour, so I'm not going to keep you for too much longer. So I just want to thank the opportunity to be with you, Gary, and appreciate the time. And then for keeping us on point, Rob, it's always a pleasure, because we can definitely spiral. One of the things that I think would be fun for the interns and really trying to look at where things are is the multiplier. And that's what I think people miss when you start looking at the buildup of debt. And the multiplier effect is if I invest $1, what am I making on the back end? And when you look at the highway system, for every dollar spent building the highways, it generated $5 of economic growth. So when you look at this, because we look at the government spending and spending and spending, it's like, but on what? Like, where's the growth? And that's when you start to see these builds. We've seen it in China. It's something that is coming to fruition, and it really comes down to the law of diminishing returns. Every new dollar is actually creating a negative util or negative growth. And that's where they keep thinking, I'm going to spend out of it. I'm going to spend out of it. It's like, but we can't. But the question is, where are we? Is the multiplier less than 1? Is it crossing over? And I think that would be a fun exercise just to see what they come up with.
Definitely. No, Mark, Gary, thank you guys both for your time, and look forward to talking with everybody next week on the next version of the 5 Things. Thank you both. Thanks, Mark.